In this recording, we're going to focus on CAP1 finance. In particular, we're going to look at Autumn 19 question 1, where I give a very good illustration of the importance of the cumulative principle in SFMA, because for question 1, the compulsory question, there was 30 marks just on CAP1 finance. So we see here, part A, it asks you calculate the expected weighted average cost of capital, your WACC, for the expansion proposal, calculate the NPV, and calculate sensitivity analysis. So for 16 marks, you covered WACC, you covered NPV, and you covered advanced investment appraisal. And actually, when we get into it, there's working capital management within that question as well to do with inventory. So that's quite a comprehensive already 16 marks, about 32 minutes. Advised in Benton's for Part B whether it should expand production or outsource by outlining 3 non-financial factors, calculate the NPV, another NPV for the outsourcing, and then give a recommendation. So another 7 marks. And then critically assess each of the 2 proposed financing alternatives and conclude or advise Benton's, another 7 marks. So you had WACC, you had NPV, you had sensitivity analysis, and you had source of finance for critically assessing them in Part C. So that was 30% compulsory part of the question. So although CAP1 finance is heavily examined in the interim assessment, it still regularly appears for a good few marks in the main exam as well. So you need to know inside out CAP1 finance for the main SFMA exam. So we'll come back and have a read of the question. Again, the examiner uses headings to guide you along, and the first 3 paragraphs are what we're interested here. Benton's is a listed furniture company, listed on the ESM market, the smaller market, and it's developed a reputation for reliable quality manufacture. So Tim and Alison own 15 and 20% respectively, with the rest being owned by what they call institutional investors, pension funds, private equity funds. They've secured a significant new customer for petrol stations, but they're going to place a large order for tables and chairs. The problem is it's going to exceed their current capacity. So they're going to have to either expand capacity, i.e. invest in new manufacturing facility, or outsource production overseas. So pay someone to do it and just take the goods in. Financing then, they don't have excess cash available, so they're either going to raise equity through a placing on the stock exchange or borrow the money. So they're either going to raise 1.2 million in equity at a share price of 1.3, or they're going to raise bank finance of 1145. And note the difference here is if you go the equity route, you have to fund transaction costs of 55,000 as well. That's why you have to raise 2 different types of finance. And you'll be paying interest at Euribor plus 8.5%. So that means if current Euribor is 1.5%, you'll be borrowing at 10%, which is quite a high interest rate in the current environment. So then we go to Appendix 1, based on the information that's given. There's your Appendix 1 on page 8. It said the details of the customer order. So you have the next 5 years, tables and chairs, with a selling price of the tables and a selling price of the chairs. So that's going to be your cash inflow in terms of your NPV analysis. You're given information about the cost of capital. So see the way the examiner uses these headings to give you an idea. That's to calculate the WACC. This is to calculate the expansion of production. And then in the next page, they tell you, here's the information for the outsourcing proposal. So they try and break it down as best possible. But this is what you should be spending your reading time doing, is going through and figuring out what exactly are you given and what are you going to use for each requirement. So we're going to first look at the cost of capital, which is Part A. You're told the current share price 135, market value of equity 11.5 million. So that means you can figure out the number of shares that they have as well. If you do 11.5 million divided by 1.35, they have about 8.5 million shares currently in issue. Current gearing ratio, the capital structure, is 20%. So 20% debt, 80% equity. And you're told the average gearing ratio for the sector is 18%. Again, why am I told that? Come back to that again. So we always ask yourself, why am I told certain things? You're told their beta and the risk-free rates. You're told their cost of debt, 9%. You're told their earnings before interest and tax. And you're also told what their interest cover is and the average interest cover. So again, ask yourself, why would I be told that piece of information? When might I need it? Right, so we'll deal with this first. We'll then go on and look at the NPV for the expansion proposal, and we'll see can we do an NPV table out. So remember, if you go back to the marks here, 16 marks for this, that's about 32 minutes. Roughly 2 minutes a mark is your timing for the SFMA exam. So we're going to look part A at a WACC computation. So part A, the WACC, we have equity, which we know is 80%, and we have debt is 20%. Now you can put in the values if you want, but you don't need, all you need is the percentages, and that comes to 100%. And we have the weight. What we now need to know is the cost. So what's the cost of equity? What is the cost of debt? Well, the cost of equity, there's two ways of getting it: the dividend valuation model or CAP1. And even for the main exam, you should have a cheat sheet done out just for a WACC. How to get the cost of each source of finance and the market value. We don't need to worry about the market values here because they give us the gearing ratio, so we know what the weight is of each one. So in our case here, the cost of equity will be the CAP1, the risk-free rate, which is 2%, plus beta, which is 2, times the market risk premium, which is 6%. Be careful there now, the market risk premium is RM minus RF already. So go back and look at your CAP1 formula. The return on the market, if they give you that directly, then you have to take off the risk-free rate again. If they give you a market risk premium, it already has RF taken off. So your cost of equity there is, we put it in percentages, 14%. Your cost of debt, we're told in the question, is 9%, but you should remember, why am I given the tax rate? Debt is after tax, so it's going to be 0.09 times 1 minus the tax rate. But that should be bread and butter to you from CAP1 and your study for the interim assessment in January, and you should have a cheat sheet of all the possible sources of finance and how to get their cost of capital. So that there should come to 7.9%, and you get the weight times the cost. This will get us our WACC. 14% times 80%, 7.9% times 20%. So I'll just do those out so you can see them. So when we add those up, your WACC is about 12.8%, but you're told in the question, round to a single number. So your WACC here will be 13%. So go back and look at the requirements, read them carefully. It said in part A, Benetton uses WACC rounded to the nearest percent. So 12.8 will round to 13%, and you will now use that in part B to do the NPV. NPV of the expansion. So there is a bit of work here, but this is all CAP1 finance, all revised early on, and you should have studied this for the interim assessment in January. But this is the compulsory question from in autumn 19 paper, so you need to know CAP1 finance well. So we're then going to have a look through how do we do the NPV for the expansion proposal. So we go to page 8 again, and we're told then all the information down here. We know it's 5 years, so we know it's going to be a 5-year one. We're told here there's sufficient space in the manufacturing facility for the capacity expansion. They have improvements made at a cost of 28. That is a sunk cost. That sunk cost has already been made, so you have to write down to get your mark. The 28 is irrelevant because it is a sunk cost. You have to invest in additional machinery of 950, so we'll put in that in a nice NPV table. So we have year 0, 1, 2, 3, 4, and 5. And you have, we're told here, this is the machinery. That's going to be an outflow in year 0. I'll just put that here. And that is going to be minus 950. So minus 950,000. No residual value at the end, and we're going to have to deal with capital allowances. But note here, tax is payable 1 year in arrears, so you're going to have to do and add a year 6 there. The main reason we're adding year 6 is it is paid in arrears. So the tax in year 5 is paid in year 6, tax in year 1 is paid in year 2. So just watch out for that in the question. Just tidy these up so we can keep them level. So then with no residual value, fixed cost of production, excluding depreciation because that's non-cash, are 206 every year. 50,000 of that is an allocation of central overheads. Variable costs are forecast to be 48 per table and 32 per chair. So we'll come in and we'll look at those in a second. But they're also told the standard working capital policies require an investment of working capital in year 1 of 265, which you will recover in year 5. So it's a temporary investment. Included in that is 95 inventory. But this is where there's a bit of working capital in as well, just to cover everything on CAP1 finance in one question. They are considering the use of a more aggressive inventory management system, which will reduce inventory from 78 days to 18. This will require the hiring of a new staff member, and it will reduce warehouse costs by 18,000. These are included in the 206,000 above, and you're told Benton's will use the more aggressive approach if it results in an increased profit. So actually within this NPV, you have to do an inventory working capital adjustment to figure out which one you'll do. So that was quite tricky because you could have put in the 206, you could put in the working capital and realized, hold on, it depends which inventory system we go with. That will dictate our fixed costs and it will dictate our working capital investment. So that is tricky and we'll come to it in a second. First thing we'll do is put in our revenue. So we're going to have revenue for tables and revenue for chairs. And that's just taking the volume, 950, 1200, etc. times 385 and the 85 for the chair. So 950 times 385, 1200 times 385, 950 times 385, 900 times 385, and 900 times 385. So nothing more there. You don't have to show detailed workings for that. Just show it's 385 times the volume. And same for chairs, it's the volume times 85. 57 times 85, 72 times 85, 57 times 85, 54 times 85, and 54 times 85. So again, just put in the easy ones. There's marks going for each one. So don't throw them away. This is the NPV table, all cash flows. And put in your variable cost for the tables. And put in your variable cost for the chairs. So you're told the variable cost down here is 48 per table, 32 per chair. So the variable cost per unit. So 48 here, 48 times 950. Remember these are minus figures. Minus 1200 times 48, minus 950 times 48, minus 900 times 48, minus 900 times 48. So the NPV is a small bit tedious more than anything, but it's important you get all the marks, particularly the easy ones, at the outset. And then the chairs is 32 variable cost per chair. So minus 57 times 32. Minus 72 times 32, minus 57 times 32, minus 54 times 32, minus 54 times 32. So all those should be relatively straightforward and easy to understand in the question. So the only thing we're really left with then is fixed cost, and we also have to deal with the working capital investment. Now you have to be careful here. The fixed costs and the working capital investment are driven by which inventory policy you choose. So you can't decide that until you figure out, are we going with the current inventory policy or the more aggressive one? And how we do that is we're going to come down and look at a separate working 1, inventory policy choice. So not only are they examining WACC, not only are they examining NPV, they're also examining working capital management. The current policy has inventory of, told here, 95,000, which is the same as 78 days. The new policy will have 95 divided by 78, which gets 1 day inventory, times 18. So they're actually going to have 18 days of inventory. So it'll be 21,923. So you can round to 22 if you want. That's what the new policy inventory would be. So that would be a reduction of inventory the investment inventory of 73,000. Now remember, if you think about working capital, that's not the saving, it's the finance saving that you have to quantify. How much will you save each year if you go with this new policy? Well, if you go with this new policy, you have 73,000 less money tied up in inventory, which means you're going to save that in finance costs each year. And how you quantify that is usually you can use the cost of debt, or we'll use the WACC here, the 13%, using the WACC. So you're saving 9,500 by reducing your inventory. There is an additional, you're told in the question, if you look at it, there's also warehouse savings of 18. We call that WH savings. You're saving another 18,000, but there is staff costs of an additional, you're told here, 23,000. So the net here is a net benefit from changing. The net saving you make is 4,500. That means the more aggressive inventory policy makes financial sense. That's important. So the more aggressive inventory policy makes financial sense, because that's what you're told here, they'll choose it if it increases profit, and we know it does. So that means here, your working capital investment now will be equal to 265, take away the 95 from before, and add back, now we're just going to round to match the solution, add back 22 instead. Because you're not going to have the 95 inventory, you're only going to have 22, because you're going to keep a lower amount. That's 192,000. So your working capital investment now, if you go up, that's going to be minus 192 up front, and plus 192 in end of year 5. Because working capital, remember, is a temporary investment, you will get it back at the end. Similarly, for fixed costs, which is related to here, your fixed costs now, they are equal to, we're told, 206,000. The first thing you take off is the 50,000. The 50,000 here, the key word there is it's an allocation of central overheads. That's not an incremental. That cost is going to be incurred anyway. It's not relevant for here, so you take that off. What we also know then is, by going with the new inventory policy, we're reducing it by 18,000, saving on the warehouse, but we're increasing it by 23. So your net fixed costs that you're going to put in each year will be 161,000. Now that is quite tricky. There's a lot going on there, the way they put a hidden working capital management piece in, and also it layered into the overall question. But what a lot of students would have done is they would have thrown in the 206, they would have thrown in the working capital of 265, and then they would have realized, oh, hold on, this is going to impact and I'm going to have to go back over my work again. So you have a learning point there, is read the full question before you go and write in anything. So we'll put in there fixed costs minus 161 in all 5 years. Right. So the only thing we're missing then is tax, which we're going to do working to. Now there's two ways of doing it. You can bring in the capital allowances directly as a cash flow if you want, but I prefer to put tax as a separate working and do it neatly down here. This should be bread and butter to you. You're going to get first, you're going to get your profits from the NPV table. We're then going to take off our capital allowances, and we're going to have to figure out, do we have a balancing allowance, balancing charge? That will get us to our taxable profits. And that will get us our tax then, 20%, and we know that's, is it 20%? 20% in arrears. So tax is 12.5%. Capital allowances is 20%. So 12.5%. So the profits in the table for year 1, 2, 3, 4, and 5, how you get those is you look at all the revenue less the expenses. What you do not include here, and that's important, you do not include the working capital or the initial investment. So all you're doing is the general day-to-day revenue and day-to-day expenses. That gets you your profits, and we know depreciation is not included there because they told us that in the question. So that's your starting point, is get your profits like that. You then take off your capital allowances. Capital allowances are not a cash flow, they are tax deductible expense. And you're told it's based on 20% per annum for 5 years. So that's 950 times 0.2, and you'll claim that over the 5 years. So you get a deduction each year. You always have to check if there's a balancing allowance, balancing charge, and you compare the tax written down value to the disposal value. The tax written down value at the end of year 5 is actually nil. Why? Because you had an asset of 950 and you've claimed 950,000 because you've claimed 20% over the 5 years. Now you could say, well, we don't claim it in the year 5. So some students might have said, actually, there's 190,000 left, tax written down value in year 5. We've sold it for nothing. So you could put here your balancing allowance to be 190,000, which would have been fine as well, because you claim it out. So whatever way you do it, it should come to say you claim the full 950. That's probably the technically more correct one. You don't claim it in the last year, because that's the year of disposal. You do a balancing allowance, balancing charge, where that would be 190,000 times 4. So you'd have 190,000 left to claim at the end of the last year. So that would get you your taxable profits. The capital allowances reduces your profits, which means it also is going to reduce your tax. So that's your starting point to make sure you know how to do your tax computation. So don't get too caught up whether you put it in capital allowance or balancing allowance, balancing charge. It's the same impact overall. You'll always come to the same position. I usually say the last year you should be doing a balancing allowance, balancing charge calculation, not claiming normal capital allowances. The tax then, be careful, it's 1 year in arrears. So tax for year 1 is paid at the end of year 2, right? And so on and so forth. Tax at the end of year, so that's 12.5%. Tax at the end of year 2 is paid at the end of year 3. So to minus 0.125 and so on. So that's why we have the year 6 column, because you actually pay the end of year 5 tax is paid in year 6. That's the only reason we need it. If it said in the question, if it said taxes paid in the year incurred, they'd be directly underneath. But that's why we have to take those now, bring them back up to the table. So no messing, it's just nice and neat tabled in. And you put your tax starting in year 2 of those line items. So the only cash flow you actually have in year 6 is the tax. So it's going to be a negative cash flow because it's only the tax. So your cash flows then, we just tot them up just to show where it's coming from. Again, you pause this now and see, can you do it yourself? So you have 1142 cash flows in year 0. Just go back and double check. So sorry, the investment and working capital now is in year 1. So I've gone that wrong. So I'll just push that minus 192, push it to here, because I would have misread it. But that working capital investment still doesn't impact your profits. So just watch for that. It only impacts your cash flows. So here's your cash flows for year 1, year 2, year 3, year 4, year 5, and you've only a single cash flow in year 6, which is your tax. And then we have to get the present value at 13%. Now you have a choice here. You can either use the discount tables, but that's fine. I'm just going to use the formula. You'll have a slightly different answer because the discount tables round obviously to 3 decimals, whereas this Excel will not. That's personal preference. But you need to be able to get the present value using either the formula approach or using the discount factor. The present value of year 0 is always the cash flow. It's at its present value already. To get the present value at any subsequent year, it is the cash flow divided by 1 plus r, which is 1.13, to the power of n, which is the number of years. So think of it, cash flow over 1 plus r to the power of n. So in this case here, that will be 238,000. For year 2, it's still over 1 plus r, but now it's to the power of 2, because it's the second year. And then year 3, over 1.13 to the power of 3. So practice you now for the next couple of years to see can you do your calculations correctly. If you did decide to use the discount factor tables, which you should bring in yourself into the exam will not give it to you because it's open book. Make sure you get similar answer. You won't get exactly the same because of rounding, but that's fine, you'll get full marks. But show the examiner what discount factors you're using. Year 4 over 1.13 to the power of 4, over 1.13 to the power of 5. And finally then, you have your 6 over 1.13 to the power of 6. So now that we have all the cash flows at their present value, we can logically add them up. And the net present value there is a positive 581,000. So from a financial perspective, this looks to make sense. It's a positive NPV. It should be proceeded with. But we have to look at whether the outsourcing makes more financial sense or not. So there is a good lot there. And remember, you only had a half an hour to do all of this question, which includes the sensitivity analysis, which is the last part of this A as well. So it's quite a tall order in 32 minutes, and you needed to have your detailed knowledge of CAP1 finance. If you're trying to rely on open book there, you're going to get caught out quite quickly. So the last thing you're asked for there then is, how sensitive is the NPV to movements in fixed costs? So they want to know, in English, by how much can the fixed costs increase by before NPV turns negative? That's what they want to know. How much can those fixed costs, the 161, increase by before they turn negative? And we have a formula, which you should have in your cheat sheet. Sensitivity in percentages equals the net present value of the project divided by the present value of the variable. And in this case, the present value of the variable here is the present value of fixed costs. So the tricky bit here is it's not a one-off item. It'd be easier if it's the present value of the machine, because that is done in year 0. It's already its present value. But the fact that fixed costs are an annual item means this, you're going to have to treat this as an annuity and get the annuity factor and then discount it back. You have two choices here. You can either use the pre-tax or post-tax fixed costs. The post-tax fixed costs are 161,000 times 1 minus 0.125. So we're going to match the suggested solution and use 140,875, because technically the fixed costs are tax deductible. So the net cost would be 140,000. If you just used 161, you get full marks as well. So either one is fine. You just get a slightly different answer. We need to know what's the present value of those fixed costs. And what you have to do is you can either discount each of them individually for 5 years, or you can realize this is actually the same cash flow every year. This is an annuity. So I can look for a 5-year annuity factor at 13%. And that would save you a bit of calculations in the exam. But that's testing your knowledge from CAP1 finance. And a lot of students got caught out on that in the autumn 19 paper. So what I'll do here is I'll just pull up an old CAP1 finance appendix. You can get these online. Get an old CAP1 finance paper. I just have 2013. You get the 2019 papers because they have a nice collection of, they give you the present value tables. They give you the annuity tables, which we need, but they also give you the CAP1 formula. So they can be useful for WACC, etc., because you're going to need a collection of those going in. You're not going to be given formula when it's an open book exam, and you need the tables for discounting. So the annuity table here, 13% for 5 years is 3.517. So instead of doing them individually, we can just say, take the cash flow, multiply it by 3.517. Just do that out so it's clear. And that says the present value of the fixed costs will be 495,000. So your sensitivity is 581,000, the NPV, over 495,000. So the answer will be in percentages, 117%. That means the fixed costs can increase by 117%, which means it can more than double. Because if you double something, you increase it by 100%. So this can more than double before the NPV turns negative. And that's an important one to see. You have plenty of scope there. You're not very sensitive to fixed costs because there's plenty of movement. It can more than double. You still have a positive NPV. But that's important. That's advanced investment appraisal, and that's what's asked for there. Right? So that was quite computational, 16 marks, about a half an hour, roughly 2 minutes a mark. But all of that was core CAP1 finance, and a lot of students would have got caught out if you were only focusing on the new stuff that's covered in CAP2. Just because it comes up in the interim assessment and it's examinable for the interim assessment does not stop CAP1 finance being examined in the main exam as well. Right? So that's your first part. We're now going to look at part B, which examines a lot of the similar stuff, is advise Bentons on whether it should expand production capacity or outsource production. Firstly, look at 3 non-financial factors, then look at the NPV for the outsourcing, and then make a conclusion. Well, let's firstly look at page 8 or 9, as it tells us about what the outsourcing proposal is. They're looking to outsource it to North China manufacturing. They will design, detailed design for tables, and they'll receive samples by November 2019 before finalising agreement. They will deliver the products to Bentons in accordance with the estimated volumes, which we have up here. There's your estimated volumes. Right. And you're told here the North China manufacturing will invoice Bentons in euros. That means there's no currency risk. So currency risk is not there. The agreed unit price will be 300 per table and 75 per chair. That's fine. So that means they won't have to buy any machinery. They won't have to make those investments. So what are 3 non-financial factors you want to consider? Well, one of the first obvious ones, and use the information in the question, you were told in the question that Benton has a reputation for reliable quality manufacturing. So the first big non-financial factor is this going to be sufficient quality? So you're told here that you're going to get samples to see and finalise agreement. So first big concern for the outsourcing, we'll come down and write it down. Outsourcing is quality of product. Will this product be sufficient quality? Can you have reliable? So reliability of supply chain. So again, what you have to figure out is, well, if you don't manufacture these in-house, you're relying on supply chains from China. And if anything delays that, think of the COVID-19 that's happened and supply chains get locked down, you are going to damage your relationship with your customers. Because if you manufacture it in-house, you have more control over what you may be able to do, whereas now you're going to be relying on outside. Timing is a big issue. November 2019 for samples. You're told here you're only going to get the samples in November 19. That leaves only 1 month before the sales in 2020. So it looks to be very tight in terms of what's going to happen. So that's a tricky one as well. And you also then have political risk associated with a foreign manufacturer. So Chinese, they could have political regime that takes over manufacturing bases. You could have different issues even within China, which may have nothing to do with Ireland, but can impact your supply chain. So all of those are non-factors. So you can see here, generally, although it might be a good idea, because one of the big benefits of the outsourcing is less capital needed, plus more scope to expand quickly. So you might argue, well, if I do the outsourcing, I don't have to spend the 950,000, right? I don't have to invest in that new equipment. And that means I can probably, if I needed to grow by 20% quickly, I can use my outsourcing partner who has that expertise to do it. So there is a lot of risk involved. You're relying a lot on the quality, and the timing could be a big issue, but there is some benefits as well. So from a non-financial perspective, it probably looks like keeping it in-house to maintain your reputation makes sense. But let's look at the NPV table for the outsourcing just to see the same again. Because you have to compare to see financially, does it make sense? And you're going to look at 0, 1, 2, 3, 4, and 5. Similar to what we looked at already. So what we're looking at now is, what's the deal? Well, the deal is you don't have any capital allowances, you don't have any investment in machinery or working capital. It's just a straight revenue and you pay them. So the revenue actually doesn't change. So we can copy it down. We have a revenue for the tables and we have revenue for the chairs. They're going to be the exact same as they were before because you're selling to the end consumer at the same price. All that's different is how much you manufacture them for. But we have a cost for the tables and we have a cost for the chairs. There's no FX risk, remember, because we're going to invoice in euros. But that could be a trouble down the line if your supplier starts acting up because exchange rates move. They may want to start being invoicing in Chinese currency. So that's something you could flag down as a potential non-financial factor. The cost of the tables, you're told in the question here, is 300 per table. So if we go back and look at the requirements, 300 per table, the volume of tables we have, you buy exactly as many as you need. So that will be 950 times 300. It will be 1200 times 300, 950 times 300, 900 times 300, and 900 times 300. So you notice straight away the cost of buying the table is much dearer than the cost of making it. The cost of making was only 48, the cost of buying it 300 from China. Likewise, the chair, cost to buy it from China 75, which includes all costs. Cost to make it less than half of that, 32. So it is going to be expensive. So 57 times 75. Double check it is 75. It is 72 times 75, 57 times 75, and that's 54 times 75, and 54 times 75. So there are all the first key elements. You have the revenue, which doesn't change from the previous example, but the cost base does change. So there are the key things that you have. What you will also have to do then, again, don't forget, is you have to do tax. So your tax there will do working one. There's no capital allowances, working one tax. So it's really just going to be taxable profits. And you're going to have tax 12.5%. So even though you're importing from China, you still have to pay tax in Ireland, and it's still going to be 12.5%. The taxable profits are just your what you sell it for less what you buy it from China. So you just add up those and bring those across the 5 years. That's 1, 2, 3, 4, 5, and then year 6. And your tax is 1 year in arrears. So 12.5% tax in year 1 is paid in year 2, and so on for the next 5 years. So there is a bit of work involved there. And remember, overall, just be conscious of timing. You only have 7 marks for the whole thing. 3 non-financial factors, 3 marks each. Probably 3 or 4 3 marks for NPV, 1 mark for conclusion. So there is a lot there. You have to manage your time and be quite disciplined in moving on. So we come back then, slot in those tax. Make sure you slot them in the right years from year 2 onwards. And then you get your cash flows. Year 0, no cash flows. And then year 1, all the way to year 6. And again, we said in year 6, you will only have the tax cash flow, so that's why it is negative. And again, you have to get the present value of 13%, and you get your NPV. So there is a lot involved there. That was a quite an onerous question one in autumn 19, because there was a lot of tedious calculations. The present value for year 1 divided by 1 plus r to the power of 1. Divided by 1 plus r to the power of 2 for year 2. Divided by 1 plus r to the power of 3. 1 plus r to the power of 4. And so on. To the power of 5. And the final one then, divided by 1 plus r to the power of 6. But remember, when you're doing these all by hand, everything takes time. And you can't rush it, because if you rush it, it won't be neat, and the examiner will not be able to follow it. So you sum those up, and that gives you a present value of 448,000. So what we can see, it is positive. It is an NPV, so it means we'd accept it. But if you compare that to the NPV we had for the expansion, which is 581, and you also compare all the non-financial factors we've looked at, in reality, the conclusion here would be based on financials and non-financials, keep in-house and expand capacity. to keep it in-house, maintain your reputation, don't have political risk, don't have supply chain risk, and financially it has a bigger NPV as well. Now, both are good from an NPV perspective, but just the expansion one, the first one, is more positive, and also it doesn't have a lot of the non-financial risks associated with it. But again, there's a lot going on there, and a lot of students got caught out there. They did not know their CAP1 finance knowledge. And remember, that's why the examiner has a question 1 that's compulsory, that if you don't know it and it's in question 1, it's a guaranteed 0. And that would have been 23, that's nearly a quarter of your SFME exam, part A and part B. So it's quite taxing, but just shows you the importance of what we call cumulative principle, and you need to go back and look at it. So the last 7 marks then is critically assess. That means look at the pros and cons of each of the 2 proposed financing alternatives and advise which to proceed with if it goes with the expansion. Because of course it doesn't need to raise the finance if it goes with the outsourcing. So they're looking here at either raising 1.2 million in equity at 130 a share. So 1.2 million at 130 means they'll issue another 923,000 shares. Or they're going to take a bank loan of 1145. So the reason they're issuing more for equity is they have to cover extra transaction costs, because that would be expensive raising equity through a placing. An equity placing to an institutional investor. And you're told the interest rate then is going to be Euribor plus 8.5%, so about 10% based on current Euribor. So we want to know what's good and bad about that. But remember, go back to the question. We had highlighted a couple of things. Why were we told the average gearing ratio for the sector? Why are we told the average interest cover ratio for the sector? Use the numbers that are given. Have that always in the back of your head. Everything is given for a reason. So take, for example, if we come down and make a couple of points, let's look at the equity first. Equity is raising 1.2 million at €1.30 a share. So the current price is 135. That's given in the question. So what you're saying here is you're giving a discount of 5 cents. Now that's usually happened to incentivize investors to take it on. But think about the shareholding. Current shares equals 11.5 million divided by 1.35. So the current amount of shares in the business, this is where you're using your numbers, is 8.5 million, 8518518, 8.51 million shares. The new shares you're going to issue is 1.2 million divided by 1.3. So that is 923,077, we say, shares. So that means the new shareholder, this new institutional shareholder, if you add both of them together, 923,077, 8518518, 23077, they're going to have about 9.7% shareholding. So there's going to be dilution of control if you bring in this new shareholder. So see the way you're using numbers there, there's going to be dilution of control. And that may be important because if you look at the current ownership that you're given in the question on page 2, Tim and Alice own 15 and 20% respectively. The remaining shares are owned by institutional investors. So this could bring in a new party, which could complicate things in terms of decision making. All right, let's go to page 8 again. So that's one element you're looking at. And you also have to notice, if you go back and look at the question, this is a PLC. So there's actually rules when you study stock market in session 9. Current shareholders have what we call a preemptive right. That means you can't just bypass current shareholders as they're suggesting and do a private equity placing to an institutional investor. There's certain rules around if it's above a certain percentage of current shares, you have to get approval from the shareholders. This currently is in and around 10%. So it most likely, this plan would need shareholder approval because they would have to waive their preemptive rights. So that's something you'd have to flag. So raising equity is expensive. We know there's 55,000 of costs. That's told in page 2. Plus, it will take time. It's a slow process because you have to agree a price and you're going to have to get shareholder approval. So overall, you don't increase the financial risk, you don't bring on debt, but it's going to be tricky, right? Because of the amount of new shareholding involved, and from your knowledge of stock market, you may have to get shareholder approval if you're not going to offer current shareholders. What usually happens if you're a PLC is you offer them a rights issue because they have a preemptive right of first refusal on any new shares. The debt position, alternatively you're going to raise debt. New debt will equal 1145 million, right? The old debt equals, now this is tricky, again the examiner is kind of applying their knowledge to see can you use the numbers. If we know the market value of equity and we know debt over debt plus equity is 20%, you can actually figure out how much is the current level of debt, right? So that's important. So how you do that, if you come back, we know x over x plus 11.5 million equals 0.2, 0.2. Because we know debt over debt plus equity is 0.2. And you can work across then, that means your debt is equal to 0.2x, because you're just multiplying across, plus 11.5 million times 0.2, which is 2.3 million. So that means here 0.8 of debt, 0.8x when you bring it across, equals 2.3 million. So your current debt, if you're just trying to figure out calculations, is 2.875 million. So if you did, just to prove it, the gearing is equal to 2.875 divided by 2.875 plus 11.5. And that, when you work it out, is your 0.2. So you know you're right. So again, you don't need all of these marks, but you certainly have to start using some of them to figure out what's going on. So that means if you took on the debt, the new gearing would be equal to, this is why we're doing it, to figure out what the new gearing looks like, 2.875, the old debt, plus 1.145, the new debt, divided by 2.875 plus 1.145 plus 11.5. So you're just adding on the new and old debt. So that overall debt will be 4.02 plus 11.5. So it'll come to about 0.26. So your new gearing is 26%, your old gearing or your current gearing is 20%. And the reason we do that is, that's why they give you the answer in the question. The average gearing ratio in the sector is 18 and you're up at now 26. Now it's not a huge amount away. Average gearing equals 0.18. So you're above average, but not by. The other piece of information that we're given in the question we haven't used is you're told the average interest cover ratio. That's always two key ratios we look at in terms of the sustainability of debt, the gearing ratio and the interest cover ratio. And if we want to know what's the new interest cover ratio if we take on this, well, the old interest we know will be 2.875 million, which is the debt, and we know the debt costs, you're told in the question, 9%. They recently refinanced the debt at 9%. So they currently have interest at 258. The new interest is going to be 1145. And we've said from the question already, they're borrowing at 10%. They're borrowing at 8.5% above your EURIBOR, and your EURIBOR is 1.5. So the total interest is 373, and the EBITDA in the question, 1965. So your new interest cover will be EBITDA over this, which is about 5.3 times. Now usually we use operating profit, but we don't have it here, so it's about 5.3 times. And you're saying the average interest cover is about 6 times. You're not a million miles away. It is falling, but you still have good cover overall. So that is a quite tricky question. A lot of application there. You had to use your numbers. Is this debt a good idea? Will it significantly change the gearing? It won't. It's still lowly geared, albeit a slightly bit higher than average. Will it drastically change the interest cover? It won't. It'll lower it, but still not a million miles away from the average. So overall, what you're asked to do is you critique both of them. So equity will be slower. It'll be more complex with fees, and it'll also be more complex that you'll dilute control. Debt, on the other hand, will be quicker. It'll be much easier to sort, much cleaner. You have no dilution of control, and it doesn't impact the key ratios. So in your head, you always have to ask, why am I told that? Why was I told the average gearing ratio? Why was I told the average interest cover? Usually when you're critiquing source of finance, particularly in CAP2 SFMA, if you're not using the numbers given, you're losing marks. So your conclusion here for the last of the 7 marks, which you're asked to advise which one, the best one here would be the debt. It's quicker, it's cheaper, and it's not going to dramatically put the company at risk based on the key ratios you looked at. So that is looking there at 30 marks for CAP1 finance. And they are compulsory marks in the Autumn 19 question 1. And it covered nearly all of CAP1 finance. Investment appraisal, 2 NPVs, source of finance, part C, critically appraising debt and equity, calculating ratios, interest cover and gearing. It looked at working capital through inventory as well, and it looked at cost of capital through WACC. So it's a very good comprehensive question looking at CAP1 finance.